Gold punched to a fresh record, and silver barely lifted its head. Most people looked at that and shrugged. I looked at it and felt my pulse pick up because I have watched this exact thing happen before, and it almost never means what the crowd thinks it means. Here is the part that should stop you cold. When one metal races out ahead and the other one just sits there, calm, quiet, left behind, that gap is not silver being weak. That gap is silver being late. And late is not the same as done. If you own silver right now, or if you sold some in frustration lately and you are sitting there wondering if you made a mistake, this is the video that was made for you. So let me give you the answer the title promised, right up front, before I prove a single word of it. The signal nobody noticed is the lag itself. Gold tends to move first. Gold leads. It is the bigger, calmer, more institutional metal, the one central banks buy by the ton, the one that gets the headlines when it makes a record. Silver is smaller, thinner, rowdier, and it tends to follow gold, but with a delay. And near the big turning points, that delay stretches out. Gold makes its record, and silver drags its feet for a while before it wakes up. So when you see gold at new highs and silver still lagging, still cheap next to it, you are not looking at silver failing. You are looking at the quiet stretch that has, more than once in history, come right before silver did the loud part. That is the whole thesis. The lag is the signal. Now let me earn it. I have spent a long time in the gold and silver world, sitting across the table from people trying to protect what they spent a lifetime building, and I will tell you the single most common mistake I see. People judge silver by whether it is keeping up with gold today. They see gold making news and silver sitting on its hands, and they decide silver is broken, or the story is over, or they missed it. And so they do the one thing that hurts them most. They let go of the metal right before it does the thing they were waiting for. The financial channels will never frame it this way for you, and there is a reason for that, which we will get to, because it is not an accident. Let me put a face on this, because I think you will recognize him. There is a fellow I will just call the patient one. Worked with his hands his whole life, an electrician, the kind of man who fixed things instead of replacing them. Years ago, he decided he did not fully trust paper promises with his savings, so he quietly put a portion into physical silver and gold and mostly forgot about it. And every so often he would check, and he would see gold in the news making a record, and silver just sitting there, and he would feel that little knot in his stomach. Did I pick the wrong one? Should I have just bought gold? I want you to hold on to him, because his story is the whole story, and I promise you we come back to him. Now, why does gold lead and silver follow? It is not magic, it is structure. Gold is money in the eyes of the people who hold real reserves. When the world gets nervous, when trust in paper wobbles, the biggest buyers on earth reach for gold first, and they buy it in size, and they buy it steadily. Silver does not get that first wave of official buying, because central banks are not filling their vaults with silver. So gold moves on the big money fear, and it moves early. Silver waits for the second engine, the public, the smaller investor, the industrial pull, and that engine starts later and slower. But when it does start, silver is a much smaller market than gold, and it does not take much money flowing in to move a small market violently. That is why silver is famous for doing nothing, doing nothing, doing nothing, and then doing everything at once. And here is where it gets interesting, because that pattern leaves a fingerprint you can actually see. There is a simple ratio, how many ounces of silver it takes to buy 1 ounce of gold. When gold has raced ahead and silver has lagged, that ratio stretches out wide. And a wide ratio is just a plain English way of saying silver has gotten cheap relative to gold. Lately, that ratio has widened out toward the higher end of where it has lived for a long time, into the neighborhood of 70 ounces of silver to 1 ounce of gold. In my years watching this, a stretched ratio near record gold has not been a warning that silver is weak. It has been the setup. It is the coiled spring. It is the lag, made into a number you can point at. But a stretched ratio by itself is just a chart. What makes this one matter is what is underneath it, in the physical world, where the metal actually lives. So let me stack the pillars, one at a time, and you will see why the lag is not a fluke this time. The first pillar is supply. The world has been running a structural silver deficit for years now, several years in a row, meaning the world uses more silver than it digs up and recycles, and the gap gets filled by drawing down the stockpiles that already exist above ground. That cannot go on forever. You cannot draw down a reservoir year after year and pretend the water level is not falling. And most of that demand is not investors, it is industry. Silver goes into solar panels, into electronics, into medical equipment, into the guts of a modern economy. And here is the cruel part for anyone hoping supply catches up easily. That industrial silver gets used in tiny amounts, spread thin across billions of devices, and most of it is never coming back. Gold gets hoarded. Gold sits in vaults and gets counted. Silver gets burned. scattered into a billion little uses, gone. So the above-ground pile that fills the deficit is quietly shrinking, while the screen shows silver napping. The second pillar is the paper market, and this is the one the big banks genuinely do not want you to understand, so pay attention. The price you see quoted for silver is set largely in the futures market, a market of paper contracts, promises to deliver metal, and there are far more ounces promised on paper than there are real ounces sitting in the vaults to back them. Most of those contracts never ask for the actual metal. They get settled in cash and rolled over, paper begetting paper. And that means the daily price can be pushed around by traders who never touch an ounce, who can lean on the price, shake out nervous holders, and buy back cheaper. I have seen it happen. Years back, the exchanges raised the cost of holding silver contracts several times in quick succession, and silver dropped hard in a matter of days, even though nothing about the real supply or the real demand had changed. Nothing fundamental broke. The paper just got heavier. That is the machine that produces the lag, and that is the machine that profits when you panic. Now, let me pause the analysis, because we have arrived at the exact spot where I owe you something real, and where I need to be honest with you about what is at stake for your money. If you have built up a real retirement, $100,000 or more in a 401k or an IRA, then the thing you are protecting is not a trade. It is your peace of mind for the rest of your life. And here is a fact that I think about a lot. The central banks, the most sophisticated money on the planet, have been buying gold at a record pace, more than 1,000 tons a year, 3 years running, roughly double what they were buying the decade before. They are not doing that for fun. They are doing it because gold in your own vault is the one asset that cannot be frozen, cannot be printed away, cannot be defaulted on by someone else. And most Americans have no idea that they are legally allowed to do a version of the very same thing inside the retirement account they already have. You can move a portion of that account into physical gold and physical silver, real metal, without paying taxes and without paying penalties, using what is called a self-directed precious metals IRA. It is not exotic. It is not a loophole for the rich. If you have $100,000 or more in any retirement account, this is available to you. The same protection the biggest institutions on earth are quietly using. I put together a free guide that walks through exactly how it works. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. That is jeffreedguide.com. Take a look, then come right back, because the next pillar is the one that ties it all together. The third pillar is history. And history is why I can say the lag is a signal and not just a hope. Go back to the great precious metals run of the 1970s. Gold came off its old fixed price after the dollar was cut loose from it, and over that decade, gold went from around $35 an ounce to over $800 by the start of 1980. But it did not go in a straight line, and this is the part almost nobody remembers. Right in the middle of that bull market, gold got cut nearly in half. It fell from around $200 down toward $100, and I promise you, at that moment, the crowd was certain the run was over. Then it turned and went up roughly 8 times over from that low into the final peak. The pause in the middle felt like the end. It was the setup. That is the emotional trap, and it looks exactly like what a lagging, sleepy metal looks like right before it moves. And silver. Silver has kissed the same ceiling twice, more than 3 decades apart. Once at the start of the 1980s and again in the early 2010s, both times up near the same round level before falling back. Think about what that means. There is a level silver has fought its way up to twice across a span of more than 30 years, and the base underneath that whole structure stretches back the better part of a lifetime. And here is the detail that should really sit with you. Silver's old high, once you adjust it for all the inflation, all the dollars printed since, is far, far above where it ever traded in plain numbers. And it has never once climbed back to that real, inflation-adjusted level. Not once. So anyone telling you silver is expensive up near its old highs is not looking at the real picture. In real terms, measured in honest money, silver has spent decades far below where it has already proven it can go. But here is where it gets strange, and this is the part that almost nobody connects. For a long time, there was a reliable rule. Gold was supposed to struggle when the return you could earn holding safe government bonds went up, because gold pays you nothing. So why hold it when you can earn a real yield elsewhere? That inverse relationship held for years. And recently, it broke. Gold climbed to records even while those real yields stayed stubbornly high, which under the old rule should have crushed it. When a rule that reliable simply stops working, It is telling you something underneath has changed, that a new and bigger buyer has walked into the room and stopped caring about the old math, because they are not buying gold for yield. They are buying it for safety, for permanence, for the fact that it belongs to no government. And when gold makes that kind of move, silver, the lagging cousin, has historically not been far behind. Let me bring the enemy back into focus, because you deserve to understand who is on the other side of your fear. When silver sits still while gold makes headlines, the story practically writes itself for the trading desks and the financial media. Silver is a disappointment. Silver is dead money, just by the stock market. And every time a nervous holder reads that and dumps his metal into the quiet, someone with a longer view and a bigger balance sheet is on the other side of that trade, happily taking it off his hands at a discount. The churn is the business. A frightened retiree selling into a shakeout is not a victim of the market. He is the product. And the silence about the structural deficit, about the paper leverage, about the central banks buying with both hands, that silence is not an oversight. It is the business model. That is exactly why nobody on the financial channels will lay this out for you the way I just did. Now I need to be honest with you, because if I only gave you the bull case, I would be doing the same thing they do, just in the other direction. Silver is volatile. It is a smaller, wilder market than gold, and it can fall hard and fast and stay down longer than feels reasonable. And the paper machine I described can keep the pressure on for a good while. Silver has recently come through a sharp correction, a real one, the kind that shakes people out and makes them swear it off. I am not going to insult you by pretending I know the day it turns, or the week, or the level. I do not. Nobody does, and anyone who tells you they do is selling you certainty they do not have. This is a case, not a guarantee, and it is not personal financial advice. What I can tell you, from having seen this movie more than once, is what the setup tends to look like. And this looks like the setup, not the ending. So what do you actually do with this, with your own money, sitting where you sit? Here is the honest, practical version, and it is principles, not a prescription. You size a position so that a shakeout can never force you to sell at the worst possible moment, because the whole game is being able to hold through the lag without flinching. You own the real thing, physical metal you or a proper custodian actually hold, not just a paper claim on somebody else's promise, because in a squeeze the paper and the metal can go two very different directions. And you make a rule with yourself, right now, in the calm, that you will not sell into the bottom, because the bottom is exactly where the machine is designed to take it from you. Decide it now, while nothing feels urgent, so the fear cannot decide it for you later. And this is the moment I most want you to understand, the recognition moment. The smart money already sees this. The central banks are already positioned, buying at a record pace. Quietly, steadily, not waiting for permission. The stretched ratio, the deficit, the broken correlation, they are already acting on all of it. The mainstream has not caught on. The pension committees, the financial anchors, the neighbor who only buys what is already going up, they are still calling silver dead money. And by the time it becomes obvious to all of them, by the time silver leads the news and every advisor suddenly recommends it, the easy part will already be behind us. Nobody sends you an invitation to this. Nobody is going to call your house and tell you the lag just ended. The whole point of understanding it now is that it does not feel urgent now. And that is precisely why now is when the decision is still cheap and still fully in your hands. Which brings me back to the patient one, the electrician who kept checking and kept feeling that knot, wondering if he had bet on the wrong metal. What he had actually done, without quite knowing it, was buy the lagging asset near a record in the leading one, and then simply refuse to let go. He was not wrong. He was early. And early always feels like wrong, right up until the moment it very suddenly feels like genius. The difference between the two is almost never intelligence. It is patience, and it is understanding what you are actually holding. So let me leave you with a real invitation, since nobody else will send you one. If you have $100,000 or more in a retirement account, and you want to understand how this applies specifically to your situation, I hold a free one-on-one educational web conference. No obligation, no pressure, just a real conversation about protecting what you have built. It is for people who watch this all the way through, so mention that you did. And the honest reason to do it now, rather than someday, is the very thing this whole video has been about. The window where a move like this is still calm, still cheap, still completely your choice, is the window when nothing feels like it is happening. That window is open right now. If you are on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffweedguide.com. That is jeffweedguide.com. Gold made its record, and silver just sat there, and almost everyone saw nothing at all. But you know better now. You know that silence is not weakness. You know the lag is the signal. And you know that a quiet stretch, the one that makes everyone else give up, is the exact stretch the patient ones are counting on. Do not be the one who let go right before the metal finally woke up.